Hey everyone, Bert Copeland with New Life CFO Services. I hope you're having a great day. I'm very proud of you because if you're watching this video, it means that you've already taken a very important step to get the rest of your business organized and hyper focus on the greatest opportunities that lay in front of you. So this is our training video that goes with the strategic prioritization matrix. And I don't know about you, but I think you're going to find this extraordinarily important because of what happened last year. In 2020, for a lot of people, it might have been the worst year in their business history. For others, for a few others, it was their best year ever. But irrespective of what happened last year, most business owners are finding themselves with tons of huge decisions to make about what is the future direction of their business, whether it's to recover their business and get it back on its feet and strong and running fast again, or if it's simply to continue to maximize the myriad of opportunities that now lay in front of them. And for this very reason, you'll enjoy this prioritization matrix. Now, when we use this matrix, we not only use it once a year in helping our clients establish direction for the year, we use it every quarter to revisit what we've done and to move forward about what new initiatives now need to be layered on top of it. So for many of y'all this last year, when you're going through the issues, priorities, or opportunities, I have a feeling that your year looks something like this. Analysis paralysis, input everywhere. You're getting advice from consultants like myself, from other business owners, from your vendors, from your customers, from your attorney, and it's just crazy. There is no lack of volume of information that's coming at you, and this is particularly very frustrating because it's so important about what's going on. Because the next few months to 12 months, maybe 24, are going to be life-changing for you and your business. Now, for me, when I look at this, it makes me think of static, like there's too many inputs coming in. So just visualize that you have, I don't know, 8 or 9 different radios going or channels of music going on, and they're all playing different music. And when that happens, none of them sound very good. It's very confusing, and it does sound like static. So we're going to try and avoid this and get you out of this dysfunctional melees that you're in and get you hyper focused on making the new and best future for your company. So just as a structural overlay about what this matrix looks like and how to use it, we're going to start out with these simpler analogies. On the left-hand side is your good old friend, the 2x2 matrix. A lot of y'all that have been in other business meetings, presentations, or MBA school, if you will, saw this a ton. And I'll tell you, it's one of my favorites. It's very powerful and it's very easy. And having that combination means that it's very easy for you to take this and move it to other people within your company. Now, look at the left-hand side because we're going to focus there. On the y-axis is alignment with skills. And when I say skills, I want you to also think about alignment with skills, core capabilities, and your overall strategic direction. Why is it that you created this company? How well does it align with those attributes? On the bottom, yes, it's the ROI deal. I am a finance person, so of course we're going to be talking about the money impact of these initiatives. Because if it doesn't drive a lot of new money in margins or EBITDA and valuation for the company, well, it's not worth doing. So the measurements that we're going to get into specifically help you to plot things along the Y and along the X axis to determine, is it something that goes hard and fast, which means that it has a high alignment along the Y axis, and it has a fast or large ROI impact along the X axis. On the other end of the spectrum, down the lower left-hand corner, if it has a low alignment on strategy or core capabilities and low impact on ROI or financials, then it's a not now or just shoot it. I've learned the hard way that working with entrepreneurs, not to say no, but often to say not now. And that's what this tool really helps to do, is communicate. Because when you're working on your initiatives and you actually plot them out using our scoring system, what you're going to find is a lot of things are going to move down to the not now, which means that you have the opportunity not to talk about them until their scores get up and higher and make them worth talking about. So I'm going to move this down over here, and we're going to talk about the right-hand side of this. This area of concentric circles, starting from core to sibling to cousin, really has to do with what are your core capabilities when it says core. And by that, it could be your products, your processes, your production capabilities. Whatever it is your core capabilities. And this comes from a book called Profit from the Core by Chris Zook. And what's interesting is Chris makes two really great points that are directly related to what we're talking about today. First and foremost, he talks about that you have to have a strong core. It's kind of like working out and doing yoga, if you will. You have to have a strong core. And before you start new initiatives, maybe your first initiatives are actually to improve the strength of your core capabilities. So if your production happens, but it's not consistent and well done, you might want to work on that first before you start adding new stresses to the company. And if you do have a strong core, then he makes the point of it's really important to only go one concentric circle at a time away from your core. Because I think he makes the argument that there is an arithmetic increase of probability that you will fail if you go from core to cousin. So always be thinking about, does it just get me to that next level of deals, and can I leverage the strengths that I already have? Because once you start losing your ability to leverage that and getting into things that you don't know, your team doesn't know, and everything else, your likelihood of failing is very large. So as we go through the scoring criterion, these two themes will resonate throughout the criterions that we're getting ready to talk about. So here are the criterions that had to do with strategic alignment. And I'm going to minimize my picture here, which is probably a blessing to everybody on this presentation. So as we're looking at this, we have across the left-hand side the key attributes: strategic alignment, leveraging our core competencies, product and competitive advantage impact, legal regulatory risk impact, technical feasibility, and the last one, probably my favorite, is the company and team buy-in. They get it. Because if they don't get it, you're like pushing a string. And then just beside that, we start getting into really a better description of what this means, that this supports our major goals, that it's in alignment with our major goals, it's in alignment with our strategy. And then core capabilities, technology, operations and support, marketing and sales and partners, that it all aligns with our capabilities here. For product and competitive advantage, that there is unique customer benefits, value for the money, customer feedback on the concept is strong to weak. This is the trickiest one on here for actually scoring, because for it to get a high score of 10 means that there's very little risk. So it's a little counterintuitive on this one that the best possible outcome means that there's almost no to virtually none of legal or regulatory risk. In fact, there may be, in this case, a risk of not doing it. But be careful when you're grading, because that's the only one that has an inverse relationship to the logic. Now, some of y'all may have already noticed that up at the top, our scoring of this is 0, 4, 7, and 10, depending on which attributes from weak to strong that it comes up with. Now, you may ask, why is that? Well, the reason for that is I don't like things to settle in the gray areas. So if I allow things to be a 1, 2, 3, well, it gets really muddy. So by doing this, we start pushing things to one extreme or the other as to whether or not how powerful they are in the weighting that we will do. Lastly, on the far right-hand side, you'll see that we give these things a rating. So not only are they rated up here at the top with the 0 through 10, but they also have a total weighting. So in this case, the strategic alignment is much more significant than team buy-in. So just keep that in mind because it'll help you to understand numerically how the scoring comes out. Now this is the financial metrics that we're looking at and we'll be scoring. When it says on the right-hand or left-hand side over here as far as future annualized impact, and then we have current year impact, targeted customers that have a know, like, and trust, and down here we have the customer client impact. So for the future annualized impact, what that's really getting into is once this initiative, this opportunity is really up and going, what kind of impact will it have for all future years going forward? A sustainable, large impact, which, as we go through here and look at it, it drives hard margin dollars. Payback and ROI is positive, and either measured in either EBITDA or cash flow. So when we're looking at this, it has the lowest is, gosh, this thing has significant upfront cash, could take 2+ years to get to break even, all the way over to annualized EBITDA impact of 5 to 10% plus a year once it's up and running. So that's a very important attribute because most companies kind of live in a 5 to 15% EBITDA. Excuse me. And if you have a few initiatives that can increase your EBITDA by going from 5 to 10% or 5 to 15%, those are home runs. That's different than the current year impact. The current year impact is really looking at two factors: how fast it can get up and going, and perhaps it's only a one-time benefit. And you may go, why would I spend time on a one-time benefit? Well, you might spend time on a one-time benefit because it helps to create the resources to then fund the initiatives that are up above it in future analyzed impact. For example, you might have some grand plans to really grow your business, and you're going to start a whole new line or open up a new plant. And that's fantastic, but you're strapped on cash. Now you may be able to borrow it, which is great depending on your borrowing capacity, or you may look at some other short-term initiatives that help drive cash flow and build up cash balances. Perhaps your inventory is too high. Perhaps you could work better on your receivables or change your terms, stretch out your vendors a little bit, or just tap into that line of credit. Either way, there are some short-term initiatives that can create real benefits before you get into the future annualized items that may go on and have benefit for years to come. Some of the current year impacts just may focus on fixing your core. So if that kind of resonated with you at the beginning about that your core is weak, well, the current year's impact and financial impact may be one of the definitions that you'll really focus on. One of my favorites is this number 9 here. Targeted customers have a strong know, like, or trust relationship with the company. Now think about that. Let's say that you want to start a brand new service line. And that service line, everybody's telling you that El Paso is the place to go, that that's really going to be the home run. The only problem is you don't know any customers in El Paso. You've never done business in El Paso. You don't know the vendors and subcontractors or anything else that's in El Paso. So what that means is your runway to get this thing up and going is going to be long and hard, because first you have to go out there and develop relationships. And then you have to get the relationships to not only know you, but then like and trust you. And that's very different than if you're just taking out of your core services, you're taking one concentric circle of new services that are aligned with your core services, and you're selling those back into the exact same customers that already know, like, and trust you. And that's especially true when you get down to number 10, when these new services help to build a better customer experience, then it's easy for the customer to implement because you're leveraging your relationships in number 9. In number 10, you're actually improving your brand when you're dealing with these customers, because and that's very powerful. It's really very powerful. We talk about branding sometimes like, oh, that's interesting. But at the end of the day, that kind of branding of making it more valuable to your customers and making it easier to implement makes you very different from your competitors and probably makes your customers much more loyal. So again, up here we have the 0, 4, 7 grading, and then you'll see the total weighting over here. So we come down and there it is, 100%. So all your weightings will come down equal 100%. Now, I did mention this, and I should have, that this is a great tool that I learned from a gentleman by the name of David Klein. He kind of walked me through this, and I went, wow, that is fantastic. Now, I've tweaked it for things that I think are greater priorities, or the weighting is very different, but a lot of this goes to Mr. Klein, who was a great advisor to me and helped me understand the value of this tool, and hopefully will help you to understand it well. With that said, let's get on to the grading. Here's what the actual grading looks like. Now bear with me, because what you want to do on this is you can see here are the individual initiatives themselves way over here. Expanding existing services into contiguous markets, acquire, hold, and improve or sell aligned acquisition targets. So all of our initiatives that you might have from your quarterly management meetings, maybe if you're in EOS from your VTO or your quarterly rocks, you'll put those initiatives down here. And then what we usually have everybody do is, based upon those definitions that we went through, we're going to have our people start grading these out. And I actually encourage you to have everybody grade theirs out separately, right? So I may put a 10 and you may put a 7 here. I may put a 10 here and you may put a 4 there. And the reason I want everybody to grade them out differently is when we see those differences about how people have graded it, it's going to really open up some rich conversations about what did I see that's very different from what you saw. So in that, just be patient in the process and allow your people to kind of work through, and I'm going to move this so that we can see the rest of these better. Allow your people to work through, because it's those conversations that will really vet the golden nuggets that are in these various initiatives. And again, at the top in the blue bar, you'll see our weighting from the prior page. And finally, with that weighting, we get all the way over here, and this initiative has a 42 alignment on our strategic initiatives. So let's see what all this is. So on that one, it's expanding existing services into contiguous market areas. Well, as far as strategic and capability score, that one has a 42. And you can see where some of our other initiatives go all the way from 42 down to 29. So that's how we grade these things out. And as we do this, we're going to go over to the financial deals. And the exercises, you're just going to go over each one of these initiatives. Everybody in your team is going to put it on their own scorecard. And then you do a Q&A, asking them, hey, what's your score? And everybody kind of agreeing. But if there's a big outlier, stop right there, have the conversation, explore the differences, and see if the team still has the same rating once those differences are understood. Now, on the financial scoring, we have the exact same initiatives because it's just a part of the chart. And when you see the entire scoring matrix, all these things are just on a long spreadsheet. And I cut them up for pasting in here only because it makes it easier to look at. But it's the same type of process to where you're going to go through and you're going to be scoring these things on 10, 7, etc. And then over here we end up with our financial ROI score, 37, 36, and these are sorted down as we go. Now here's the interesting part. When you're going through and sorting these things, you can go through and you'll weight them out, and then you grab the whole set and you sort them from high to low. And then ask yourself, does this sequence make sense to you? Does something not look right? Did I really expect my expand service product offerings into existing customers to end up with a 36 or only a 36? Gosh, maybe I thought it was a 10, 10, 10. And that's really healthy because it makes you go back and says, am I missing something? Let's go back and re-examine our individual scoring things, because the consensus is we thought this would be higher or lower. So again, it helps to create a very rich conversation, not only on the individual data points, but on the cumulative scores and making sure that those make sense. And when you do that, you'll have a well-vetted scoring matrix, which ultimately will look like this. In this case, we've taken the combination of the strategic capability score and the financial or ROI score, and we've come up with a total score way over here on the right-hand side from 78, 75, and 68. Now this is really great because we're going to put, if you took the strategic capabilities and you plotted these along the y-axis, and then you took your financial score and you plot these along the x-axis, you're actually going to be able to place these initiatives on that 2x2 matrix that we looked at previously. And that's really a great way to go, because now you know where they align on there, and you can see, according to that previous scoring, which ones that we're going to move forward with hard and heavy, and which ones we're going to try and see if we can recreate them to be more valuable or push them down into the not now. So let's take another look at that. So just as a reminder, we have all these going on over here. We have alignment with skills and strategy. And so the lower score ones on here would be down in this area of either not now or possibly their subsets, all the way up to these really align. And then down here we have significant and fast ROI. So I changed that definition a little bit. So these things create significant new cash, new ROI, and we can get there very quickly. So it's that balancing act between size of ROI and how fast we can get it. And as you plot these things out, that's why I have these little circles all over the place, because those are our different initiatives. You'll end up with 3, maybe 5 that end up here in this upper right-hand quadrant. And those are the ones you're going to prioritize on. Those would have individual scores. Maybe that's our 78, and here's our 68 and 65, or whatever the case may be. And these are the ones that we now agree on. That's our focus for the quarter. That's our focus for the year. And we're really not going to worry about some of these other things down here for the time being. Maybe not at all. But for the time being, they are on the back burner. So what's really great about this tool, I'm sure each of y'all have somebody on your management team that kind of consumes the room, if you will. In my management team, that's me. But they consume the room in that their voice is so big and they're so persuasive that sometimes their voice overwhelms the logic about what we're doing. By doing this scoring and allowing everybody to score individually, it allows everybody to have an equal say in what the initiatives are, even if they're more quiet, shy, or possibly an introvert. And by that way, you may get the silent but really smart people on your team to really help assess what the priorities are. And by having the scores, you'll find that they're willing to talk about it a lot more and be more impassioned about their score versus everyone else's. But the real power here is that you're only going to have 3 to 5 up here in the go hard and fast. And everything else is on a not now or not quite yet. So on the two extremes, the upper left and the lower right, I have limit scope to a critical few. So these things have high alignment with our strategy, but so far their ROI is not all that great. So a lot of times in those projects, there may be opportunities to break it down to the critical few sets of that scope, the few jewels that really drive cash, and not everything, and move those critical few over into the go hard and fast. And then on the lower right hand side, you might have some things with low alignment but great money. And that might be that working capital thing that we talked about. Improving our working capital to generate cash, maybe liquidate our inventory. It's not very strategic, but it does create a lot of cash very fast. And that way, doing that, we can move it up and just says we're going to focus on inventory liquidation or reducing our days in inventory in half and really generate a whole bunch of cash. And because we separated that down, we can now move it up into go hard and fast for 2 reasons. Because it's quick to do, and there's a large amount of cash or ROI that comes from that. Now that could be up there to enable some of the other things that are really in the go hard and fast. So think of it as a funding exercise and not necessarily to where everything has to be on the strategic alignment to be there. The last thing that we do when we actually grade these things out, so when people come to the meetings, be it our quarterly L10s or just our quarterly management meetings, somebody comes up with another great idea. And we will literally go through the exercise of scoring out those new great ideas to see if they're better than the green dots that are already here. And if they are better, then we're going to go back and ask the question about, we need to get the existing green dots done before we start new ones. Because again, that adage that we've already talked about is nobody wins the Super Bowl by spiking the ball at the 5-yard line. So even if you have new great ideas that outscore the ones that are up here, if they're already in place, then go ahead and finish the existing greens before you start a new one. Because that will, again, build infrastructure, build cash, build new sources of revenue, and hopefully EBITDA because I like EBITDA to be built a lot more than I just like my revenue to be built. Hopefully that'll make sense, and this will create a great level of discipline within your company that when people have new ideas, they already know in their head that it's going to go through the scoring filter and that they're going to need to present it in such a way that aligns with the scoring filter that's already out there so they can be talking to their team about that. One other thing that we like to do when we're talking about new initiatives, let's say that we've already defined everything that's in the go hard and fast area. So the next step is really to look at plotting out what success looks like. We all know Stephen Covey about start with the end in mind, and that's kind of where this comes from. But over my years, especially when I owned another business, I had a lot of salespeople working for me. And in managing new salespeople, I came up with what I call the cone of performance. So visualize, if you will, that you're interviewing a new salesperson, and here comes, Bob that has a great reputation from one of your competitors in the marketplace. And you're talking to Bob. It's like, Bob, this sounds like a great fit. You clearly know the products, you know the markets, you're well connected, you have a great reputation. So tell me, Bob, in the next 3, 6, 9, and 12 months, what you think you're going to be able to do as far as new sales and bookings. And then we can look at, as you get ramped up to your run rate, what does that look like? What does that blue line look like for you, Bob? And of course, Bob, being a salesperson, is going to tell me about some great objectives that he has, and he's going to be blowing it out of the water. And I said, that's fantastic. In this next line, I've actually used in interviews. I said, that's great, but tell me, Bob, in your own opinion, what sales efforts or what sales numbers at 3, 6, 9, and 12 months, in your own definition, means that this is not working out, that you're not making the traction that you are, and I call that the lowest acceptable sales. And if you look at those two lines between the green line and the blue line, I call that the cone of performance. So I get those two data points because then I get with Bob and said, Bob, what we're going to do here is we're going to track your actual performance. And I don't expect you to be blowing it through the blue line immediately or like that. But as long as your performance is going towards the blue line and it looks like you're going to hit it or get real close or hopefully go above it, then we're going to be in great shape. But Bob, if your performance starts to tail off and go towards the green line, then the nature of our conversation is going to change. What do we need to do to get you back on track? What is your revised tracking as far as your blue line, your green line? And do you think this is curable? Because if it's not curable and you're heading towards the green line, then we might as well save each other a whole bunch of angst and anxiety and everything else, and go ahead and plot a different course of your career, maybe with somebody else or maybe at a different part in this company. But you're going to be held accountable for performing within this cone of performance. It's very powerful in managing your salespeople. It's also very powerful in defining your new initiatives. So let's start with our new success. And let's say that you are going to open up a new branch in El Paso. Then you need to kind of plot out, what do we think the revenue track will look like for that new branch? This is why we're opening it. This is why we're excited about it. And in 3, 6, and you may go out for 2 years, this is what we think it'll do to our company. And then also plot out your green line, lowest acceptable sales of, golly, if we don't at least get to this, then we're probably just wasting our time relative to our other resources. And what we thought we would get out of the scoring matrix is not coming to fruition when we did the current year financial impact or in the annualized financial impact. So you will actually plot out your performance within this cone of performance on your new initiatives too. Lastly, if it is a separate business, I will actually put in there the break-even line of what we think is modeled out for that business. And that helps me to know that, gosh, at least once I get over that line, I'm not consuming resources anymore. And if this is a big investment, this might be your cash line and not just your revenue line. Because in a major initiative, you're going to have major upfront cash to invest in something like this before you even get into positive cash. So think about that. And you might consider the green line a stop loss line. But it tells you what you decided in advance what failure looks like, as well as in advance what success looks like. So where that's also important is too often when people start new initiatives, start a new business, launch a new region or center, they become emotionally attached to that initiative, right? And when they're emotionally attached and things aren't going well, they will rationalize that behavior and do whatever it takes to try and get it back on track. Or, I just need more time, or it's going to come next month. Just like Bob, the salesperson. Well, I have a lot of opportunities, they just haven't landed yet. But when you do this and you define what failure looks like in advance, it really helps to back up and says, you know what? We agreed up front and invest in this thing that if it started to go towards the trend line, the green line, that we would kill it early and often, as it's clearly not going to yield what we thought, and we may be wasting cash on this that we could deploy somewhere else. So that's very important. For some of y'all to really do this, while the graph looks very interesting, and it really is simple to do if you're talking to a salesperson, if you're talking about new products, new regions, new companies, that's more difficult, and you're going to need to get some people with a really savvy financial acumen. Maybe you have a good controller or analyst on your team that could help you model out what the new business or endeavor looks like. But this is a really important concept so that everybody understands what the stop line is, as well as this looks like it's going to be moving forward, and that you can pivot as you're going through that. Now that's all we have today, and with that I want to make sure that you know about the things that we're doing here to make sure that you're well supported in this effort. So first and foremost, you want to make sure that you're going to our website to download the actual scoring worksheets. It should have been on the exact same page as this was. This is the instructional video. Please feel free to share this with your staff and your crew so that they kind of understand how it works before you all start. And also, we want to offer you a free 1-hour consultation that will come out and sit with you and really go over all your Q&As about how to use this tool. Happy to do so, because we're just that vested in how important it is for you and your company to stay hyper-focused and getting the big things done as soon as possible. We also, for some of y'all, we've had some people raise their hand and says, I'm not sure if I don't really just need more. So if you need more help, you can also go on our website and ask for another consult. And what we can really talk about is, do you need us to host this working session about how to use this tool? Because what we're going to dive into is really getting into those rich conversations when the scores differ, and making sure that we're really exploring the hard conversations about what is in alignment with your strategy and how these things work or don't work, and modifying the scores, because we've used it all the time, so we're very familiar with the scoring nuances and how to explain them with your team. The other areas where you may need some help is quantifying the financial impact. So when you're looking at the annualized impact or the first year impact, we can help you if you don't have the resources on your team to really quantify what that impact is. And then lastly, the cone of performance may actually get you into building out some financial models about what the new business, new region, new location, new product lines look like. And it's critically important that you define not only the model of here's the projected revenues or whatever the case may be, but make sure that you are defining both sets of parameters between the lowest level of acceptable performance and the highest level of this is why we invested in this business. In doing this, we usually come up with other metrics that we'd help you monitor, or that would lay out to you and your team to monitor along the way, and not just the revenue or EBITDA, because most new big initiatives have several things to make sure that you're tracking to make sure it's on track. So I hope that was really helpful for you, and be sure to download all the free stuff, get into the deals, and no problem, just fill out the form about a free consultation, and we will get that scheduled up and get with you. And then again, after that, if you need some additional help from you and your team of either hosting, quantifying, or building the business plans, we're happy to do that too. Other than that, I hope you have a great day. Thanks for spending your time with me, and you take care.